So good morning, my colleagues, and I do hope everyone is doing well. So we're back in chapter 7, and I want to pick up here on where we left off. So I want to talk about market efficiency and stock valuation. So they bring up the term rational buyers. And rational buyers mean people who kind of use their head to before they buy stock. So you have a rational buyer, and of course, on the other side, you're always going to have a seller, right? Because if you have a buyer, you have to have a seller. It's a zero-sum game. So they use their assessment of an asset's risk and return, and these are the magic words here, right? A risk and return, to determine its value. To a buyer, the asset's value represents the maximum purchase price, and to a seller, it represents the minimum sale price. So, and as you know, markets are competitive, right? Everything's competitive in life, and there's a lot of us trading. So the fact that there's so many people trading with the law of large numbers, eventually prices will reach an equilibrium on average, right? So this is an important term, right? Prices will finally reach a point where they want to be with buyers and sellers, an equilibrium price. And that equilibrium price, it will be known as the market value. Okay. So hold on. Why did it? I don't want to do that. So it's the market value. So I'll highlight that. Okay. So this reflects, again, it's collective actions that buyers and sellers take on the basis of all the available information. Now that's of course in a legal market. Some people have more information than others in real life, but we won't talk about that because that's called insider trading, right? Buyers and sellers digest new information quickly as it becomes available, and through their purchase and sale activities, they create a new market equilibrium price. So you're going to have stock price fluctuations every moment of every day, right? And then they're trying to get toward a new equilibrium. And of course, there will always be shocks, right? Stock shocks when things happen. Look at Moderna with their COVID vaccine. Moderna was at 70, now it's at 100, going to be 170. So we look at this whole concept of price equilibrium and settling on a price as market efficiency, and we saw that in chapter 2. So we'll call that market. That's called market efficiency, right? All right. So the University of, and this is an interesting little fact here. Okay, this is a little factoid. The University of Michigan produces a monthly survey measuring consumer confidence, and that survey routinely causes stock prices to move when it is released. So in June 2013, various news organizations reported that Thomson Reuters had a contract allowing it to distribute information about the monthly consumer confidence survey to its clients via a conference call. 5 minutes before the survey results were posted on the university's website, the contract contained another provision that allowed Thomson to distribute survey results electronically at 9:54:58, 2 seconds prior to the conference call. The 2 seconds of lead time over the test of the rest of the market could allow these clients to trade stocks before most market participants learned about the new information in the survey. All right. So we have this idea of an efficient market hypothesis where prices are determining, basically making the market most efficient because of price discovery. And, you'll always have people out there who do research and they look for undervalued or overvalued stock, such as Warren Return, right? And Bill Gross, who are fund managers, famous fund managers, and they've found and they've managed and they've gotten pretty good abnormal high returns on their portfolios because they seem to know they've had some knowledge. Wouldn't call it inside information. All right, so there's a term that's used a lot now and bantered about, and it's called behavioral finance, and it reflects on how people react to the markets. So this new body of research is called behavioral finance, and let me click on that. So it's a growing body of research that focuses on investor behavior and its impact on investment decisions and stock prices. Okay. So there are people who absolutely believe in behavioral finance, and they're called behaviorists. And there's a certain truth to this, that people will behave in typical ways. So a famous gentleman by the name of Dan Kahneman got the 2002 Nobel Prize in economics for integrating insights from psychology and economics and into how people trade in the stock market. And then Richard Thaler received the 2017 Nobel Prize on the tendency of the stock market to overreact to trends, the economic consequences of consumers failing to exert self-control. Okay, so there's a whole study on people's psychological behavior with regard to trading, and there's a lot of different terms that are thrown around, and you could actually take classes in behavioral finance, and I'm sure you can get one at Stony Brook if you look on the course catalog. All right, so let's look at a little bit on behavioral finance here, and let's discuss that. It's called human behavior. Okay. All right, so there's a lot of different theories, and we'll look at a couple of them now. Okay. So behavioral finance has a number of theories to help explain how human emotions influence people in their investment decisions. All right, so the first term is regret theory, and I'm going to highlight that in blue. Okay. And that deals with the emotional reaction people experience after realizing they have made an error in judgment. When deciding whether to sell a stock, investors become emotionally affected by the price at which they purchased the stock. Sale at a loss would confirm the investor miscalculated the value of the stock when it was purchased. Okay, the next term is herding. You know, like herds of cattle. Let's highlight that if we can. Let's highlight herd. Herding is another market behavior affecting investor decisions. Some investors rationalize their decision to buy certain stocks because everyone else is doing it. And you see this a lot. You see this a lot. Investors may feel less embarrassment about losing money on a popular stock than about losing money on an unknown or unpopular stock. So there's a lot of terms, okay? So people place particular events into mental accounts, okay? So there's a lot of so people there's a lot of research that's done on people. You know, there's a lot of mental stress, okay? And another term that we'll look at here is prospect theory. Prospect theory, right? People express a different degree of emotion toward gains than losses. Individuals are stressed more by prospective losses than they are buoyed by their prospect of equal gains. All right, anchoring is a term here that the tendency of investors to place more value on recent information. So people tend to give too much credence to recent market opinions. Okay, so I want to kind of move on now to the how to start valuing common stock dividends and how to value stocks in general, okay? So we're going to see the terms expected and required return a lot. So we'll see those. All right. So the common stock dividend valuation model, which is the first one we're going to do. So what we should all know is kind of like we valued a bond previously, right? The value of a share of common stock is equal to the present value of all future cash inflows it expected to provide. So when we looked at equation 6.4, that could be used, and I don't want to click on this and end up going back. So that can be used to find the value of a share of stock. So we're going to discount its expected cash flows back to the present. All right. Although a stockholder can earn capital gains by selling stock at a price above that originally paid, what buyer really pays is the right to all future dividends. Now, there's going to be stocks that don't pay dividends, so we're going to address that soon, okay? How do we value a stock if they don't pay dividends? Okay, so we'll address that right here. Stocks have a value attributable to a future dividend stream or to the proceeds from the sale of the company. All right, so let's look at equation 7.1 here. So the basic dividend valuation model is this equation right here. And in the numerator, you can see the stream of dividends, right? See them all? Infinitely, right? Technically, stocks have an infinite life, technically anyway. And here is your required return, okay, on that stock. So you've seen this before with regards to bonds, this equation. So this is the value of today of a share of common stock. And we're going to look at a couple different models. Okay, so we're going to use this as a jumping off point, as a baseline equation, and then we're going to just modify that as we bring up different types of models. Okay, so the first model I want to talk about is called the zero growth dividend model. Okay, so what is the zero growth dividend model? And that assumes a constant non-growing dividend stream. You get the same dividend forever, kind of just like you would get with preferred stock, right? Right, technically, right? Or with a console bond that goes on forever, all right? So mature, steady income-producing firms that have already made and cultivated their long-term strategy, strategic investments, exemplify firms that pay a constant dividend over time. So you can see what they say here. So the dividends for each never change. You see that? They're always the same. Okay. So, be that as it may, under the zero growth model, the price of a share, and this is pretty theoretical, it doesn't always obviously hold, the price of a share of common stock for a stock that pays a constant dividend is going to be, forgetting about everything you see in blue, okay? All we care about is the result on the right here. It'll be the dividend just divided by your required return. It's that simple, okay? Basic, simple algebra here, or arithmetic. So the value of a share of common stock simply equals the present value of a perpetuity of D1 discounted at a required rate of return. So we already looked at a perpetuity in Chapter 5, okay? So this is an important thing to remember and kind of know. All right, I'm going to play this little 58-second video, and hopefully the microphone will pick it up.
One of the easiest time value of money tools to use is the formula that calculates the present value of a perpetuity. You might think that a perpetuity, a stream of cash flows that remains fixed forever, is not something that you will encounter very often in the real world. But in fact, there are a number of real-world applications of the perpetuity formula. Most preferred stocks pay a dividend that is fixed and has no maturity date. In this example, the Denham Company's preferred stock pays an annual dividend of $3, and the company plans to keep paying that dividend indefinitely. Since the stream of dividend payments is a constant perpetuity, we use the zero growth model to estimate the value of the preferred stock. Assuming that the next dividend payment comes 1 year from now, the value of Denham's preferred stock is equal to the dividend payment divided by the required return. If the next dividend payment is $3 and the required return is 15%, then the value of Denham's preferred stock is $20 per share.
Okay, so I hope that was clear, and it was just a nice simple calculation that that was done to drive home that point. All right, so we're almost 17 minutes into that now, and I'll pick up over here at preferred stock valuation in the next video.